Jill, impressively and appropriately, was named only recently as the Deputy Director of Economy and Trade at the American First Policy Institute, Jill, and was really a key advisor on the legislation for Opportunity Zones 2.0. So we have somebody very close to the program and somebody who really did influence policy as the bill was being written. And there was a lot of late night machinations and liaison work with Senator Tim Scott's office, even the White House. And we're really pleased to have Jill with us today. So that is our panel. And we're going to first talk about the BBB and some of the provisions now being afforded to real estate investors. So Opportunity Zones, certainly one, but there are other unique tax provisions, Brendan, that an individual should consider and potentially take advantage of. So you want to walk us through the framework of BBB as it applies to real estate investing?
Yeah, absolutely. The bill that passed on July 4th is largely a continuation of and reinstatement of policies that were already very favorable to real estate, both on the investor side and on the developer side. Some of those key provisions are the 20% pass-through deduction, sometimes called the Section 199A deduction for qualified income, which rental real estate income is, reduces the effective tax rate of that income on an individual's tax return by 20%. So it takes the top rate down from 37% down to 29.6%. Critically, I think bonus depreciation, 100% bonus depreciation has been reinstated and made permanent. This allows businesses and owners of real estate to write off certain kinds of assets, not the building, but anything that is personal property, furniture, fixtures, equipment, tenant improvements for commercial buildings, allows them to write off and recover the full cost of those expenditures as a tax deduction in the year those are placed in service. And that, coupled with Opportunity Zones, is incredibly powerful because it creates deductions for the investors, and we avoid depreciation recapture when we sell this because the full gain from an Opportunity Zone is excluded from federal taxable income. Varies in each state based on their rules, but incredibly powerful, incredibly big lift to the return on Opportunity Zone deals. And it's incredibly difficult to model that into the underwriting on this. So most of the underwriting is probably a little light on the tax benefits. Other important provisions.
Brendan, may I interject at this point just to clarify? It's a very important point. So we get to use depreciation in traditional real estate investment, but we must recapture at terminal sale that
Correct.
depreciation. In an Opportunity Zone, we get to utilize effective, I think, January 17th of this year, bonus depreciation, so accelerated depreciation, and we still retain the opportunity for no recapture. Is that correct?
Yes, with the exception of it's after January 19th. That's the only change I would make to what you said. Inauguration day and forward, if that's enough to think about it. Other expensing provisions, Section 179, which allows, effectively the same result as 100% bonus depreciation, slightly different qualifications. That's been enhanced both in terms of the dollar value and what qualifies. And there's been a change. I won't bore anybody with the details on deductible interest, but there's been a favorable change that allows real estates and other businesses to deduct additional interest expense that was previously limited the last few years. Other positive changes, low-income tax credits, low-income housing tax credits, and new markets tax credits, which often get paired with real estate developments, have been enhanced. However, there's a couple of energy efficient credits and deductions that have gone away or will be going away shortly for commercial real estate. Those include Section 179D, which is a per square foot deduction based on energy efficient property. that has been placed in service, and 45L, which is a per home clean energy credit that is sunsetting in the middle of next year. However, I think one of the best things is that we have seen success with the Opportunity Zone 1.0 program, hundreds of billions, I think, of dollars invested into the program. Great new developments, revitalization of areas, and Opportunity Zone 2.0 under the what I'm calling the OB3 legislation gives us a lot of clarity because it has made opportunity zones permanent, and it gives us a lot of what we were asking for from a reporting standpoint and an impact standpoint on how is it impacting these low income areas, and starting January 1st of 2027, a redesignation and tightening of the requirements for which areas qualify for opportunity zone investment. They've sort of re-upped the benefits for Opportunity Zone 2.0 over the last couple of years. One of the key benefits, which is the deferral of tax on capital gains, the time value of that has gone down, and then there was a 10 or 15% basis step up that was available for early investors into Opportunity Zone 1.0 that has been eliminated after the end of 2021. That 10% basis step up, which says if I have $1 million of gain and I invest in an Opportunity Zone fund, ultimately when that gain comes due, I'm only paying tax on 900,000 of that. So there's 10% that's permanently excluded from tax, and then you get a full 5-year deferral. The permanence gives businesses a lot of confidence to move forward with this. Other big provisions that were made permanent that really impact businesses include the R&D tax credit, which and how that's computed and the deductions associated with that. That had really it had been renewed every few years with the expectation that it was always going to be renewed. There were some big changes the last go round on this, but the permanence gives, I think, everybody here on the investor and on the developer owner side that this is part of the tax code. It can only be changed via congressional action. And so it is in there as permanent as anything can be on the tax front, and we don't have to worry about it going away overnight or with just the passage of time.
Yes, excellent. Well, thank you, Brendan.